Deep in the dark, temperature-controlled data centers of modern Wall Street, massive arrays of supercomputers are quietly churning through trillions of dollars. Let's say you take $100 million to AQR, the world's largest hedge fund. In a recent presentation, they pitched an aggressive strategy to new clients. Give us a decade, and we will triple your money. But along with that massive return, they make a secondary, deeply counterintuitive promise. Over that same 10-year period, they also plan to intentionally generate over $580 million in financial losses. Historically, a hedge fund justified its high fees by chasing what the industry calls alpha, the rare ability to reliably outsmart the broader stock market and deliver outsized returns. But as trading became dominated by highly efficient algorithms, finding that pure market alpha became nearly impossible. So quantitative analysts realized there was another source of returns they could beat instead. The financial industry's most lucrative product has shifted. It now functions as an engine designed to make the massive tax liabilities of the ultra-wealthy legally vanish. To understand how they do this, we look at a retail strategy called tax loss harvesting. If you buy a variety of stocks, some will naturally go up and others will go down. This animated chart shows a portfolio divided into winners and losers. By selling the red, losing stocks, the tax code allows you to deduct that loss, using it to offset the capital gains taxes owed on the green stocks you keep. It is perfectly legal, and almost every robo-advisor does it automatically. But relying on the natural ebb and flow of the market is far too slow and mathematically insufficient to protect a billionaire's fortune. That is where hedge funds introduce a highly engineered strategy known as tax-aware long-short investing. They take the basic concept of harvesting losses and apply heavy leverage. In this diagram, you start with a standard $100 investment block. The fund takes your money, goes to a bank, and borrows another $100 against it, taking that combined capital to buy $200 worth of stock. Then, they simultaneously short or bet against $100 of other stocks. There is now $300 of total market movement at play. Yet, because the long and short positions act as opposing forces, your actual net exposure remains exactly $100. By taking these massive bets, the fund mathematically guarantees one side will suffer a severe deliberate loss, generating a massive tax write-off. Applying borrowed leverage to contradicting bets transforms an ordinary tax mitigation technique into an industrial-scale loss generation machine. But there are strict legal roadblocks. The IRS forbids you from shorting the exact same stock you own, a move called a straddle. And if you sell a losing stock, you can't immediately buy it back. That is a wash sale. To bypass these specific IRS rules, analysts rely on a quantitative methodology known as factor investing. Instead of looking at a stock as a specific company with a recognizable brand, algorithms strip away the name entirely. They evaluate the asset strictly as a bundle of abstract data points, mapping out factors like market size, momentum, and volatility. This allows a supercomputer to sell a losing stock to harvest the tax write-off and instantly buy a mathematically identical replacement stock that happens to carry a legally distinct corporate ID. By reducing real-world corporations to pure quantitative data, hedge funds can seamlessly clone their financial exposure while navigating right around IRS restrictions. The $580 million in promised losses are entirely synthetic. These engineered setbacks cause no real economic damage to the client's wealth, as they occur within a perfectly hedged structure. Instead, those generated losses function as a massive banked reserve. Investors apply them to wipe out the capital gains taxes on their entirely separate investments, effectively driving their overall tax rate down to zero. The final result is an impenetrable barrier, constructed out of algorithms and leverage that shields accumulated wealth from being taxed or extracted. We tend to assume that as finance gets more efficient, it gets better at funding the best ideas and building the future. But sometimes, peak financial efficiency just means applying the world's most powerful computers to the singular goal of hiding money from the government.